Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the 3 market catalysts we're watching this hour. First up, Nvidia earnings due out this week. We break down what to expect from the world's most valuable company. Plus, Federal Reserve Chair Jerome Powell sounding a dovish tone in Jackson Hole. Is a rate cut a sure thing next month? We'll discuss. And cryptocurrencies rallying on the back of Powell's comments. Can the risk-on rally continue? We'll discuss that and more on Market Catalysts. Let's get a quick check of the market. Taking a look at the major averages, we're seeing red across the screen. Dow was off around 110 points. The S&P 500 and the Nasdaq are both off roughly 0.1%, and this comes after the massive melt up that we saw in U.S. equities on Friday following that Jerome Powell speech in Jackson Hole. I also want to take a look at the bond market. We've been consistently checking the Treasury market to see the reaction following Powell's comments. We are seeing yields tick slightly higher. The 10-year is still firmly below 4.3%. The 30-year yield is hovering around 4.9%. So something that we'll continue to watch as we track these Fed rate cut expectations. But also up this week, Nvidia. Will Nvidia earnings save the market rally? The AI chip giant reports its second quarter results after the close on Wednesday. And after last week's slight pullback in the tech trade, investors are looking for Nvidia to lift sentiment once again. The stock holds a massive weight in the S&P 500 index at nearly 8%. Joining me now is Maribel Lopez, the founder of Lopez Research. So Maribel, the biggest stock in this market, expectations obviously sky high. Can Nvidia live up to the hype once again?
I think this quarter we're going to see that Nvidia is still in the pole position as far as AI is concerned. They are really the only game in town for real money making in the AI infrastructure business. We saw all the cloud computing hyperscalers come out with really strong cloud and AI numbers, and that can only mean good things for Nvidia this quarter and frankly for several more quarters to come.
Now, one risk analysts have been pointing to is China. We heard from KeyBank last week that guidance for Nvidia may exclude H20 sales because license approvals, they haven't come through yet. So if Nvidia can't include China revenue, how much of a risk is that to the stock?
I think what we're seeing with China is going to continue to be a wild card, but in general, the fundamentals for Nvidia for several quarters to come are quite strong. They're going to sell everything they can make, whether they sell it to China or they shift in production and decide to try to make more chips for what would be the US hyperscalers. So no matter what happens, Nvidia will sell everything that they can sell. The question, I think, is whether or not the market has overpriced optimism, and if there's even the slightest blip, if that will take an impact on the stock. And I think that is a legitimate risk because the enthusiasm in AI has been incredibly high, and even the slightest indication that there might be some crack in Nvidia will send it into a tail.
So when you look at the China revenue picture, if we can't include that, do you think that sets Nvidia up to maybe miss consensus estimates?
It has the opportunity, but frankly, I don't think China is the biggest issue. I'd be more concerned with if we saw a pullback in the hyperscalers in terms of their demand for the latest Blackwell chips. We also have some other competitive pressures that people don't talk a lot about, but we still see that AMD has the opportunity to try to undercut Nvidia in certain contracts moving forward. But we're just starting to see that build in now from the hyperscalers, so it could take several quarters for us to actually see that.
And you were just talking about the demand from the hyperscalers, which we saw play out this earnings season. I'm curious if you think that a lot of that story has been priced into shares. We are up over 30% since the start of the year.
It's almost hard to imagine that we could price in more in the shares from where Nvidia is right now. The enthusiasm has been at an all-time high. Having said that, there are very few alternatives if you really want to participate in a meaningful way in the AI game right now. They seem to be the picks and shovels for anybody that wants to build AI anywhere.
And if most of the optimism is priced in, and most of the demand is priced in, where do you think the next leg of growth is going to come for someone like Nvidia?
Actually, the next leg of growth, so we've got a short term and a long term. And in the short term, it's keep on keeping on. This is the next several quarters. There has been a lag in enterprise demand for picking up these AI services. So the hyperscalers are building. The question is, are the enterprise buyers going to buy it? And that could be where we start to see some of the cracks in the short term of the AI space. In the longer run, there's some investments that Nvidia has made that I think will be very important. They talk about it as physical AI is what we once knew as robotics, the advance of that. There's a lot of upside in manufacturing, in digital twins, in robotics for them as a longer game, but there might be a space in the middle where we don't see that quite pick up yet, and the enterprise demand is not quite picked up yet. So for several quarters, it looks like the buying trend is going to continue. They'll be in the mix. Clearly, they're driving the mix. And then the question is, do we actually have enough enterprise demand? And a lot of that will be based on how businesses feel customer sentiment in general is going for purchases and how much they're willing to invest ahead of that with an uncertain economic environment globally.
Mm-hmm. And what do you make of Jensen Huang's relationship with this administration? He's met with President Trump several times. It seems like he's trying to find a solution that appeases both the government and policy side along with the fundamentals of his company. Do you think that's an important piece of the puzzle when we look at NVIDIA's future success?
I think what's happening right now is that the US government is very interested in the chip trade, bringing that chip trade to the US. I think there's been a lot of negotiations that's been done, even with a 15% tariff placed on NVIDIA chips that go to China. They still get to sell those chips in China, so it's still good for them in that perspective. From the concept of the government right now, they're really very interested in creating a strong, secure US infrastructure. So I would say that any major corporation in tech should be working with the government to understand what their priorities are and how they can balance capitalism versus government intervention.
Mm-hmm. And speaking of this, the U.S. government just took a 10% stake in Intel as part of that push to secure more domestic chip making. But Intel, still in the middle of its turnaround, really lags the AI story relative to competitors. Does this government investment change your confidence in Intel moving forward?
So I think there's two things we have to look at here. Yes, is the answer to your initial question. I think the government investment in Intel actually makes it a little more secure for the buyers to think about, if I'm building something for 3 years from now, is Intel actually going to be a viable concern? I think that that actually has been taken off the table to some degree. That has nothing to do with whether or not Intel will manufacture the product that somebody wants to buy. That's a different question. But I also think this investment in Intel in some ways has been, shall we say, not positioned the way it actually is. If we look at the CHIPS Act, they were supposed to be awarded $7.8 billion in CHIPS Act, and then another $3.2 billion in the Department of Defense contract. That's roughly $11 billion. They had only received about $2.2 billion of that as of this month. So realistically, all that money that's being invested had already been earmarked to be invested in some manner, shape, or form. And the real trade was to say, you're going to give us 10% in the stock, which I think was meant to basically prop the stock up and give the overall buying populace confidence that Intel would be a going concern moving forward. And also to make sure that they have a stake in understanding who might be interested in investing in Intel moving forward.
Very interesting stuff. We'll have to continue to watch the space and see what happens. NVIDIA earnings on Wednesday. Maribel Lopez, thank you so much.
Thank you, Allie.
Coming up, we dive into the latest crypto moves. That's next on Market Catalysts. Fed Chair Jerome Powell's dovish comments on interest rates lit a fire under stocks, but also boosted cryptocurrencies. Ethereum touched an all-time high on Sunday before pulling back to kick off the week. But what does Ethereum's recent rise mean for the broader crypto sector? I'm joined by Ryan Rasmussen, Bitwise head of research. So Ryan, Ethereum hovering near those record levels, up more than 20% over the past month. What's driving this move to the upside, and how does Ethereum differ from Bitcoin?
Those are all great questions. We're really excited about Ethereum at Bitwise for a number of reasons. But as you mentioned, it's rallied pretty strongly over the past few months, reaching all-time highs over this weekend, prices it hadn't seen since 2021. So investors are really excited about where Ethereum is headed. And of course, it's outperformed Bitcoin in the more recent months. But you nailed it on the head when asking how are they different? Because they are very different types of crypto assets. A lot of investors speak to us and they say, what's the difference between Bitcoin and Ethereum? Why do both need to exist? And the reason is that they solve different problems. Bitcoin solves the problem of a digital store of value like gold. That's why many investors think of it like gold as a fixed supply. Its price is based on supply and demand, and it's actually relatively simple from that perspective. Now, Ethereum is very different. The best way to think about Ethereum is as an operating system for crypto applications. Those applications are things like stable coins and asset tokenization, which investors are extremely excited about. Those are the types of things that are built on top of Ethereum in the same way that applications like Uber and Venmo and Instagram are built on top of Apple's operating system or Google's operating system. So it really is a different kind of asset, a different kind of technology. Of course, fundamentally, this is all blockchain, but Bitcoin and Ethereum both solve different problems. And that's why investors view them as two different things. Bitcoin like gold, Ethereum like a tech investment.
And you were mentioning how Ethereum has outpaced Bitcoin when it comes to some of those gains. And Bitcoin is still the most accepted cryptocurrency, but we didn't see it rally as much as Ethereum after Powell's speech last week. Why didn't we see that same pop in Bitcoin?
That's exactly right. Now, both of these are interest rate sensitive assets to some extent because macro factors do impact crypto investments, but Bitcoin is driven by slightly different fundamentals than Ethereum. And I think the rally in Ethereum and perhaps is more than that in Bitcoin because investors are now excited about this technology over the long term. And they see that interest rates could come down faster than people were expecting given Powell's statements. And that means we're going to see more investment into these types of technologies, high growth, highly disruptive technologies. I think investors are no longer hedging that fiscal uncertainty and financial uncertainty that the markets were trying to weather past week while holding positions like Bitcoin. And now they're saying, okay, look, we're starting to see light at the end of the tunnel from an interest rate perspective. That means we're going to see more capital investment into new types of innovative technologies. And Ethereum really fits that picture more than Bitcoin does.
And your firm, Bitwise, is very bullish on Bitcoin over the next decade. You have it rising to $1.3 million by 2035. What do you think will spark that long-term rally?
We're so excited about Bitcoin over the next 10 years and really beyond that. Last week, we published the first long-term capital market assumptions paper for Bitcoin ever in its 15-year plus history. And you're right, we predicted that Bitcoin would get to 1.3 million over the next 10 years, achieving an annualized growth rate somewhere near 30%, which of course outperforms all other asset classes. And there's a number of drivers that we think will push it there. This continual concern with federal debt and more broadly government debt and the debasement of fiat currencies and other reasons why people would invest in assets like gold. It's the same reason that people would invest in hard assets like Bitcoin. So we think that that picture is not getting any prettier. There's no way that if Elon Musk couldn't come in with Doge and rein in government spending while Trump was very supportive of it, we don't think another regime is going to be able to do that. And for that reason, we think investors will continue to turn to hard assets like Bitcoin, which, by the way, is up significantly over the past year and 2 years, outperforming all other major asset classes because there's just not enough Bitcoin to go around. And the demand for Bitcoin is skyrocketing, not only for the reason that I mentioned, but because now with the launch of ETFs last year, now institutional investors could gain access to Bitcoin through ETFs in their portfolio in the same way they get exposure to gold, other commodities, other stocks. And that is unlocking this wave of demand that has been sidelined for 15 plus years of Bitcoin's history. So we think what's driving Bitcoin up above $1 million over the next 10 years is there's reasons to invest in hard assets like Bitcoin, and institutional investors can finally do that through ETFs. And that combination of factors we think will just push the price higher given its fixed supply.
Now, given that, if we look at cryptos in general, whether it be Ethereum currently trading at record highs or Bitcoin, which as you said has just been an outperformer over the past 2 years, how should investors think about timing? Do you buy at these levels? Do you wait for a pullback? Is there a way to game the crypto market in any sense?
Look, the way that we invest in crypto here at Bitwise, and when we talk to our clients, which we spend all day, every day going around talking to financial advisors, family offices, high net worth individuals, and the like, is that crypto is a long-term investment. Whether it's Bitcoin or Ethereum or other crypto assets, the time horizon is very long. So of course, we like to buy the dips. A lot of the investors that we work with like to allocate when the market has a drawback, like Bitcoin has right now, about 10% down from its all-time highs. But we're really long-term oriented here at Bitwise. A lot of the studies that we run, back testing how Bitcoin, how Ethereum, how other crypto assets would have performed in a portfolio, show that you should have at least a 3-year or more holding period when you hold these assets, because they are volatile and they do fluctuate up and down quite a bit relative to traditional assets. So we believe that you should constantly be allocating and rebalancing your portfolio so that it doesn't become too large of a position, but it also doesn't become too small of a position, because there are those boom and bust cycles for crypto. So long-term time horizon, constant rebalancing and sizing is really, really important. And of course, we love to buy the dip here at Bitwise.
And buy the dip. Ryan, thank you so much. Appreciate it.
Thanks, Allie.
Coming up, we're taking a look at some trending tickers, plus what potential rate cuts could mean for the housing market. That's next.
Welcome back to Yahoo Finance. I'm Brooke Tabama. We're live with the NASDAQ. Let's get a quick check on the latest market action. We're about 1 hour into today's trading session. And right now we're seeing all three major indices, or rather Dow and S&P 500 in the red. The NASDAQ flipping just a tint up to the green in this morning's early market trading. Taking a closer look at the YF Interactive, we do see once again the NASDAQ gaining some momentum, up nearly 0.03%. We also have the S&P 500 reversing to the downside after that rally that we saw on Friday after Federal Reserve Chair Jerome Powell hinted at a September rate cut. That certainly gained lots of momentum across all three major indices. The Dow was up also on Friday, now down about 0.5%, down 0.45, roughly 200 points. Taking a closer look at what exactly is moving the market action, we did see Nvidia flip into the green, and that's what's really moving the momentum when it comes to the NASDAQ, reversing the losses that we saw this morning. If you take a look at Nvidia, now that stock is up about 0.5%, and that comes ahead of its key earnings report. There's lots of high hopes and lots of eyes on what exactly the guidance will be. Of course, this stock has really led the AI revolution. Year to date, that stock has had lots of momentum and lots of optimism on the street, up more than 30% year to date. And in the last year, that stock is up 38%. I also want to take a look at retail. It's also a big week when it comes to retail stocks, including the likes of Gap, Abercrombie, Ulta, as well as Best Buy. All reporting this week. We also have Dollar General coming out. And as you can see here, Walmart reversing some of the losses that we saw last week after the company reported its first earnings miss since 2022. That stock now up nearly 0.7% into today's open. Also, Dollar General under a bit of pressure as they're set to report their quarterly earnings report. And there's lots of insight remain to be seen about how exactly the low-income consumer is holding up in this report. We also have Kohl's. They're set to report their earnings this week, down nearly 1% in intraday trading today. There'll be lots of discussion about how exactly the value-conscious consumer is doing, especially ahead of the back-to-school season. But besides these top stocks, we have many of the retail stocks in the red. Ulta, Lowe's, Home Depot both reported last week. Target also holding on to that pressure that we saw last week. And also Best Buy, I want to point out that stock down nearly 3% ahead of their key report. But taking a zoom out, once again, a bit of a mixed picture here as we make our way into this week's trading session. The NASDAQ flipping to the upside in the green, but the Dow and S&P 500 both in the red. Keep it here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching Figma, Comcast, and Netflix. First up, Figma. Wall Street analysts starting their coverage of the recently IPO'd design firm today. The analysts initiating coverage with neutral ratings as they weigh the design software maker's valuation amid stiff competition against its potential for AI-driven growth. Figma made a stellar debut on the New York Stock Exchange last month, with its share price more than doubling to $85 from its prior IPO price of $33. Next, Comcast and Disney. The parent companies of NBC and ABC, respectively, are in focus today as President Trump lashes out against them, citing biases in their coverage. The president said he would support the FCC in revoking licenses to their television stations. For context, the FCC issues licenses to owners of television stations, which must be periodically renewed. Finally, Netflix, the streaming company seeing its new release top the charts at the box office, K-pop Demon Hunters. That's an animated musical released by Netflix, and it topped the US and Canadian box office during its two-day theatrical debut. It's a rare win at the theaters for the streaming giant, which usually avoids chasing box office revenue for its original movies. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Home builders moving sharply higher Friday after Fed Chair Jerome Powell opened the door to potential rate cuts as soon as September. The group is up more than 10% so far this year. But today, some of the biggest U.S. names in the sector are giving back a bit of those gains. The question now, will Powell's signal be enough to jumpstart the housing market? I want to bring in Brett Ryan, Deutsche Bank senior U.S. economist, and Daryl Fairweather, Redfin chief economist. So, Brett, let's start with you here. Markets are pricing in that 25 basis point cut in September, and you see a total of 75 basis points by year end. How much could that translate into broader economic support here? And specifically, how much relief can it provide to the housing market, which we know is so closely tied to the consumer?
Sure. Thank you for having me in the program. And we did bring our call forward. We expect 3 rate cuts once a quarter. As Powell said, though, we think it's going to be a slower pace every other meeting as opposed to consecutive meetings. So the feed through into the housing market may not be as dramatic as basis point, for example, in terms of rates. And one of the reasons why is we think 10-year rates are going to remain high, and that's because of term premiums. So even though the Fed's cutting 75 basis points, that may not translate into an exactly 75 basis points reduction in mortgage rates. They may remain somewhat elevated. They'll come down a little bit, but maybe not, probably not the full 75 basis points that we expect. So conditions still a little bit restrictive.
And Brett, that's a great point. Daryl, I want to bring you into that conversation as well, because a lot of people think a Fed cut automatically means lower borrowing costs, but it is more complicated than that. And we actually did see mortgage rates rise after the last Fed cut. So what drives the disconnect? And with rates now at a 10-month low, how much do you think a September cut has already been priced in?
Mortgage lenders are very quick to react to any changes in the market. So we're already seeing that mortgage rates are significantly lower than they were just a few weeks ago. And that even changed on Friday when Jerome Powell was talking about how unemployment is more of a risk. We saw mortgage rates drop. And the spread between mortgage rates and treasury yields is tightening, which means that there's even more room for rates to drop if yields on treasuries stay high. So I think there's a lot of reasons to be optimistic. And if you are a home buyer, I would definitely go talk to a lender this week and find out what rate you can personally get, because the rate that you see advertised is not necessarily the rate that you will get. If you have a great credit score, then maybe you can get an even better rate.
And given where rates are today, how much has that moved the needle when it comes to affordability? Are you seeing any signs that it's bringing more buyers back into this market?
Buyers are incredibly rate sensitive. It's the thing that they watch. It's what affects how expensive their monthly payment is going to be. So anytime that rates move, we do see buyers reacting. And now buyers are getting a little bit more motivation to go look at homes. It's the end of summer. It's not the most popular time to search for a home, but it's also a time when a lot of sellers are getting nervous that they haven't gotten any offers yet. So it could be perfect timing for somebody who wants to come in under asking price and get a slightly lower rate than they would have been able to get earlier this summer.
Now, Brett, this is a question I've been thinking about because millennials, first-time home buyers, they're having to wait a lot longer to enter the housing market. How does that shift in behavior, more renting, less home equity, impact or maybe could impact the broader economy over time?
Sure. So I think the first place to start is the supply of homes for sale. And as Daryl pointed out, sellers are getting a little bit more nervous. A lot of those sellers are baby boomers that are downsizing, and those homes and they have a significant equity saved up in them. So what you're seeing is the month supply of homes for sale at the current rate. That's they've been ticking up recently. Median new home prices are down, let's call it on average, about 2.5% year over year. And you're seeing existing home prices also dipping, approaching flat year over year. So discounts are starting to come back into the market as people start to need to move inventory. And I think that's part of the story, as Daryl pointed out. along with rates. And that could, be an important part of the story as well in terms of bringing younger generations into the home market that have really been boxed out by high rates over the past few years.
So then, Daryl, how do you address this affordability problem over the long term? Do you see this becoming maybe more of a federal policy issue? And have we seen any successful government interventions in the past?
There is a bill in the Senate right now to increase the supply of housing, but the most important things are happening at a local level. California has made it easier to build dense housing, and hopefully they keep making progress on that front. Other states have made it easier, like Florida and Montana. So I think what could be different this time around if rates drop is that it's not just going to be an increase in demand for housing. We could also see an increase in the supply of housing, which would be a really welcome improvement from the last rate cycles we've seen.
And to that point, we did receive new home sales earlier this morning. The demand for new homes was stronger than Wall Street anticipated in July. So a sign of maybe some resiliency in housing, even with all these affordability challenges. But Brett and Daryl, thank you so much for your insights. Appreciate it.
Thank you.
Great, thank you.
All your market action is straight ahead. Stay tuned. You're watching Market Catalysts.
Industrials, the top performing sector in the S&P 500 so far this year, up more than 16% now year to date. And as markets rally around Fed Chair Jerome Powell's comments on the path forward for interest rates, there could be some interesting opportunities for investors within industrials. We're navigating how to play the space with the Yahoo Finance playbook. Joining now is Kristen Owen, Senior Analyst and Managing Director at Oppenheimer. Kristen, it is good to see you. So let's start with the news today, Kristen. That would be Jay Powell, Jackson Hole seems to be suggesting there, Kristen, a policy pivot is on the way. Let's say that happens. What could that broadly mean for the industrials you cover, Kristen?
Yeah, thanks, Josh, for having me on. It is an interesting day and one where we're seeing a little bit of exuberance come back into the market. And I think the expectation here is, both a little bit of clarity, and this has been a market that has been missing clarity thus far this year. So a little bit better certainty with respect to those September rate cuts, but also a little bit better on the affordability front. When you think about industrials, I mean, we're talking about capital equipment, capital goods. These tend to be large, in some cases, multi-million-dollar investments that really make our economy run. And so if we are at a point where we're now starting to see rates come down, or the expectation that rates are going to come down, that affordability piece gets a little less challenged, and the decision to make some of those larger investments becomes a little bit easier here. So the way that I look at it, we've got some certain pockets of the market where there are some clear opportunities. When you look at who's responding well today, and you see a name like Caterpillar up 4%, certainly getting some benefit from the opportunity for resi improvement. And that's something where, we think that there is a real opportunity now in anticipation of rate cuts that could revive this resi sector that's been bumping along the bottom. A few other names in that space that we like. Trimble would be one that we'd put in that bucket. A little bit less capital intensive, but certainly tied to that affordability and improving resi and housing outlook. So I'd leave it there. I mean, we have a lot of opportunities here for the affordability to get a bit better.
And Kristen, for investors, the Fed, one critical theme. Trade is another, Kristen. Now, I think about trade tensions. I think about some of those industrials being front and center. And I'm just curious how the names you cover, Kristen, how they've been sort of just navigating that tariff dynamic, mitigation strategies, levers they've been pulling.
Yeah. Josh, I started with this idea of clarity or certainty, and that's something that has really been a challenge for a lot of the companies in this space. And that's primarily related to the tariff backdrop. How we've seen most of our companies respond thus far is take a slow and steady approach. It is, how can we control the controllables? Let's try to make any move that we take more palatable for our customers, meaning it's not necessarily a knee-jerk reaction to increase price. Let's see what we can do within our own supply chain, and let's not make any any regrettable decisions at this point, given that we haven't had a lot of clarity on what that tariff backdrop is going to look like. So some of the other developments this week, a little bit more codification on what EU tariffs are going to look like. That's going to create a little bit more certainty for how do I address my supply base that may be coming from Europe? How do I think about those Section 232 or the steel and aluminum tariffs when I'm starting to think about how I build this piece of equipment or this piece of machinery? And first and foremost, starting with the supply chain before thinking about, do I need to reshore? Do I need to bring more of that manufacturing back either to the United States or under USMCA compliance?
Kristen, I want to end here with some picks, some names. Caterpillar is one name I know you mentioned. I know you like that. You also like Deere. Why is that one a buy here, Kristen?
I mean, Deere is one that can also benefit from the construction side of the business. We don't often talk about Deere's construction business, certainly more well known for its ag business, but that's one that can benefit from this affordability backdrop. On the ag cycle, I mean, ag tends to move to the beat of its own drum. And from that respect, Deere is the best in class name that you can own in the ag machinery space. And what we would really benefit from, in addition to the rate cut, is really understanding what trade policy is going to look like from an agriculture market perspective. That's going to be more meaningful for the commodities backdrop. That's really going to be the kicker to Deere shares here. Right now, what we like about Deere is with a little bit of help from the macro, you can still get earnings growth next year, and that's what's currently being priced into the stock. On top of that, you get a nice dividend, you get high quality management team, strong free cash flow conversion. These are all things that for a multi-year investor really screen quite well here.
And how about CNH, Kristen?
CNH is much more of a self-help story here and hasn't had as much of a run as Deere has had. So you don't have that premium multiple applied for CNH. We think that actually creates a multiple opportunity for them. They've called out 350 to 450 basis points of operating margin opportunity just within their control, just by executing better quality equipment, integrating more of their own technology into their machines. So when I think about Deere versus CNH, Deere is probably already well priced for a lot of the premium execution that they get. CNH has a little bit more of a catch-up opportunity and is trading at a slightly lower multiple, so a little bit more attractive valuation relative to Deere.
Kristen, appreciate your time and those picks.
Retail earnings on deck this week. Results due out from Kohl's, Best Buy, Gap, Dollar General, and Dick's Sporting Goods. Joining me now, Deborah Weinswig, Coresight Research founder and CEO. Deborah, thank you so much for being here. You've said spending patterns are really polarized right now. You're seeing affluent households still confident while lower income shoppers are strained and they're trading down. How is that divide showing up in the earnings results we've seen so far?
Well, first, thank you for having me. And we continue to see this true bifurcation, almost like this hourglass of the consumer. And so as we look at what we saw last week from an earnings perspective, not only are certain retailers you wouldn't expect seeing this kind of almost trading up or trading over, but I think that this kind of continuous squeeze in the middle, and what we've started to see around this kind of eggflation period is that consumers under 100,000 household income were not only seeing kind of continuous declines in consumer confidence, but also in terms of spending. And so it was really broken down $100,000 and over, very little change, and if not kind of an upside to the positive with what we've seen in the stock market and also the housing market. 50,000 to 100,000, we've seen a continuous kind of low single digit decline, and then 0 to 50,000, almost like a double digit decline.
Yeah, super interesting. And the early reports, Walmart, Costco, some of these more staple names, they show a consumer that's prioritizing essentials. But this week's slate is much more discretionary, right? We have Kohl's, Gap, Best Buy. What do you expect to learn from this round of results, and how might it differ from what we heard from some of those staples?
It's a very important point, I think. And also, if you look at some of the companies like a Walmart and TJ Maxx, which do appear to be gaining not only mind share, but market share. If you look at Prime Day, what I thought was a Prime Week, I guess it is now, we saw from companies like Kohl's and Dick's Sporting Goods and Best Buy actually were really almost a change in the model and the approach and really leaning into innovation. And so I think those retailers who are really have a much more flexible kind of expense base, so more varied versus fixed costs. And I think those three retailers are great examples. I think we're going to continue to see a stronger top line and more of that falling through to the bottom line.
Now, President Trump says furniture tariffs are coming later this year. Based on your research, what we've heard from these companies, how are consumers handling these higher costs? And with furniture tariffs now in play, how much more can they really absorb?
Yeah, on the furniture side, which is a sector that has been, I would say, dynamic and more challenged, right? We're seeing strength in housewares, but furniture has continued to have a tougher year overall. That's not really a sector you can kind of accelerate the product that you're bringing in just because, right, that's on a ship versus air freight for the most part. And not, yes, you have some of that made domestically, but I do think that that sector is more challenged in terms of absorbing. But I think that is one where you'll see more of that price pass through to the consumer. As long as it's well telegraphed, the consumer potentially will get ahead of it, right? So if they have a purchase, those purchases are usually planned. That's not usually kind of a impulse buy. So I think what you might see, which is what we saw in electronics, is more of that kind of pulled forward very quickly.
Interesting. So how will that shape some of the winners and losers in retail, not just when we look ahead to potential furniture tariffs, but also this bifurcation that you were just mentioning, right? Higher income versus lower income. Are we seeing that play out in the stock market when it comes to some of these companies that are doing better than others?
But what we're seeing is even higher income consumers, because, right, there's this concern over potentially what might happen in their future. Right. I wouldn't even say that they're trading down. They're kind of trading over and they're making more informed decisions. And what we've seen is the consumer is visiting more locations before they convert. And they're trying to get the lowest price across the board. And so I think that retailers who have these alternative revenue streams, Walmart's a great example. I mean, even Target, and it's retail media, it's data as a service, retail as a service, and we're continuing to see like Walmart Plus membership plays like a Costco, which is also what Walmart Plus is. But this idea that you have, and TJ Maxx does that, right? They have their credit card, which they have significant penetration. Kohl's does also. So I think if you have an alternative revenue stream so that you can help the consumer absorb, going back to a more flexible model, I think that those retailers near term and medium term will be in better shape. And I think they'll be able to flex more with the consumer. What you're seeing in terms of kind of broadly in retail is those retailers who don't have a more flexible model from a kind of revenue and income perspective, they're less able to absorb, they're less able to flex price. And I think whether it's furniture or other tariffs, those are the retailers we're going to see more challenged. And I think that their ability to not only communicate to the consumer, but to offer prices that are affordable, it's going to be a haves and have-nots environment, consumer and for the retailers.
And real quickly, a headline I want to get your opinion on: Guess looking to go private. Should we expect more consolidation in the retail space as consumers are weathering this, and really companies are looking to navigate this more polarized environment?
I mean, I'm actually at NACDS, which is the largest chain drugstore conference, and think about what we've seen in chain drug with Walgreens going private, Rite Aid, kind of chapter 22, right? Chapter 11 twice. I think that we're seeing an unprecedented environment in retail where if you haven't gotten into this alternative revenue, it's not that you can't, but if you haven't started to think about alternative revenue streams early on, there's only so much you can absorb. And at some points there are decisions that you have to make that are, gloomier and gloomiest, if you will. And so I think that, and in some cases, right, these private equity firms, they've done an amazing job in terms of shared services, marketing and other costs that are becoming even higher for retailers and more difficult to absorb and maybe unexpected, right? In a Gen AI world, there are so many different ways to approach marketing. That's the number one pain point that we're seeing across the board. And so I think that we've seen kind of, if you go back over the past 5 years, unprecedented bankruptcies and, kind of acquisitions by private equity. I mean, there's of course I think we've seen 24 retail bankruptcies this year. We will probably continue to see more of the same, but I do think we're starting to see almost these, kind of these retailers who are complementary, who are kind of helping each other think through how to digest some of these changes. So I think that between now and the back half of the year, we'll see less of that. But I think we're also going to see, this continuous kind of going back to the haves, right? We're seeing some malls with unprecedented occupancy and traffic. And I think this kind of bifurcation of the market is just going to continue to grow.
Very interesting stuff in this space right now. Deborah, thank you so much.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, President Trump set to meet with South Korea today. How will the talks impact trade negotiations, and which sector should you watch? More ahead. Plus, traders size up the timeline and outlook for rate cuts. We'll discuss the health of the U.S. economy as Wall Street bets on lower rates. And retailers gear up to report earnings with tariffs in focus. We'll bring you the latest names being impacted by the trade war as President Trump threatens a new sector. We'll discuss that and much more on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Allie Canal. Let's get a check of the market action. You're taking a look at the major averages. You're seeing the Dow off over 200 points. The S&P 500 is also off around 0.1%. And the NASDAQ, the only index to be in the green. We actually flipped into the green shortly after the opening bell. And what's helping lift the NASDAQ is Nvidia and a lot of those Mag 7 players. You're seeing Nvidia up over 1%. Of course, Nvidia earnings are due on Wednesday, and this is going to be key for this market rally. You're also seeing Alphabet, a nice pop there. Amazon, Apple, Microsoft, Broadcom, all trading in the green today. Now, this comes after stocks really rallied to end the week last week after Jerome Powell gave that dovish speech in Jackson Hole. What's interesting today is that you're seeing the equal weighted index underperform the headline S&P 500 index, but this wasn't necessarily the case over a 5-day period. Over the past 5 days, you're up 1.4 roughly in the equal weighted index. The headline index has definitely lagged that, just around 0.1%. And this comes as we've been speaking about this market rotation story. That's been considered a healthy movement in this rally. But currently today, we are seeing those tech stocks lead the way higher here. So keeping a look at all the indexes here, but right now a bit of a mixed picture on Wall Street. Well, South Korean President Lee heading to the White House for his first in-person meeting with President Trump. Lee will be joined by executives from the country's largest companies, Hyundai, Samsung, SK Hynix, and LG. Meanwhile, President Trump posting on Truth Social as he gears up for the meeting, saying, quote, "What is going on in South Korea? Seems like a purge or revolution. We can't have that and do business there." So what's top of mind for each of these world leaders? Here with more is Ambassador Kirk Tong, managing partner at the Asia Group, and Yahoo Finance Washington correspondent Ben Worschkel. So Ben, let's start with you here. Can you walk us through the main objectives going into the South Korea summit? What does South Korea want, and what is the Trump administration pushing for?
Yeah, good morning, Allie. So I think you kind of in your intro you outlined kind of the two poles of this conversation. One is these business side issues. We have these CEOs in tow, and shipbuilding is another major part of these talks. Part of the recent deal with South Korea was $150 billion for shipbuilding in the U.S. That's a big theme of the president's visit this week, and is a big issue for Trump that he likes, that he would be very supportive. As the overall context here is to try to improve business ties and finalize this trade deal, which still has a lot of sparse details on it. The other side are these other issues that I think have a lot of people holding their breath as to whether these talks in about an hour could go sideways. The Trump's post this morning about a purge in South Korea also mentioned how he thought that they couldn't do business there because of this. This is an apparent reference to the unrest that happened under the previous South Korean president when he declared martial law for about 6 hours, and the meeting today is with his successor. Another big issue there is security, national security. North Korea, security there. U.S. troops have been stationed in South Korea for 73 years now. now, and that's always been a big issue for Trump, and that's another one we're hearing a lot of focus on. I think the bottom line here is the South Korean official told reporters this morning that the President Lee's visit here, his goal is pragmatic diplomacy. So kind of a little bit more get items checked off the list, get items done. But I think a lot of people are holding their breath as to sort of what exactly happens at 12:15 when the two presidents will be before cameras in the Oval Office.
So, Ambassador, I want to bring you in here. You've just heard Ben laying out some of those expectations. How are you viewing this summit?
I think it's a very high stakes and important meeting for the U.S.-Korea relationship. President Lee is prepared assiduously for it, although he's only been president for a few months, and bringing significant deliverables to the United States in the form of increased Korean investment into the U.S. And his main goal is to stabilize the state of affairs, reach an understanding on the parameters of the defense relationship, and announce significant investment in the United States that makes the U.S. happy about the state of affairs on the economic front. There are some pitfalls in all this, and we'll be watching quite closely. The Asia Group's been following this each step of the way, but there's that gauntlet that each visitor to the United States, to the White House these days, seems to go through with that initial Oval Office meeting. If that goes well, then I think we'll see announcements being made and things will be on track for the relationship.
You were just mentioning some of those investments, and South Korean negotiators, they have agreed to billions in U.S. investments. That's in an effort to avoid some harsher tariffs. How much leverage does Seoul really have, given their dependence on both the U.S. for security and then China for trade?
Well, I think they've got significant leverage in terms of what they can bring to the U.S. economy. South Korean companies have been investing a lot in the United States over the last decade, and they're making this pledge to increase that. And just as the United States is dependent upon the U.S. for its defense, ultimately at the end of the day, the U.S. is dependent upon Korea being on side and favorable towards the United States in this larger struggle for leadership and authority with China. So it's a mutual dependency. Korea just needs to work through the difficulties of operating with a fast-moving transactional presidency in order to reaffirm the relationship.
So what would a successful summit look like for both sides?
I think that I expect there will be announcements about some specifics going forward on Korean investment in the U.S., a solidification of the tariff schedule that Korea will be facing going forward, and then some statements about what Korea is willing and is not willing to do in terms of regional defense in support of the United States regional defense efforts in the Western Pacific. There may also be, although not necessarily, some statements about the future of the U.S. military presence, the command and control structure, and some of the financing for how the U.S. defense presence in Korea is paid for.
Now, Ben, outside of South Korea, we also heard from Canada's Prime Minister Mark Carney on Friday. He's dropping some retaliatory tariffs on U.S. goods, but keeping levies on cars, steel, and aluminum. How significant is this in the context of trade talks between the U.S. and Canada?
Yeah, I think the major thing to take away from this announcement, and Carney said it himself, is that this is about kind of siloing off the USMCA piece of this. These are actually the bulk of goods that go across the U.S. and Canada that on the U.S. side of tariffs have remained largely duty-free, and now Carney is equalizing that on the other side. So the deadline to watch there is actually not until next year. That's when the USMCA is up for renewal, and that's when the bulk of this. There's still going to be a lot of back and forth over these specific sectors. Autos is a major one, of course, but there's a number of sectors like that do have tariffs on them that are going to be going back and forth. But it does sort of set aside this, by some estimates, 60% of the trade back and forth that is under USMCA that's largely duty-free that now will have months before the renewal process peaks next July.
Another big U.S. trade relationship is, of course, China. Trade talks have once again been extended. So, Ambassador, I want to get your opinion on U.S.-China trade negotiations. We seem to be in this endless 90-day pause cycle. Do you see that continuing? What path forward do you see when it comes to something concrete?
I do expect that tariff levels will stay roughly where they are for the remainder of the year. And I do think that the U.S. and China have kind of boxed or dueled to somewhat of a tie or a draw in terms of their bringing leverage on technology controls from the U.S. side and limitations on rare earths and magnets exports from the China side. That resulted in a stalemate. So with stalemate on tariffs and technology, what's left is transactional deals that can be made. What I expect to see, and it seems to be heading firmly in this direction, is a visit by the U.S. president to China that will result in significant commercial announcements and perhaps some market opening measures by China. The time is short to negotiate that, and it seems like it might be difficult to have anything more dramatic than what I just mentioned. But things do seem to be heading in that direction of some short-term mutually beneficial announcements that can be realized despite the broader stalemate.
All right, we'll see what's to come. Ambassador Kirk Tong and Ben Worshgold, thank you both so much for being here. PDD, the parent company of Temu, posting better than expected second quarter earnings, getting a boost from China's latest round of stimulus aimed at supporting consumers and offsetting the impact of U.S. tariffs. So does that make China an attractive investment right now, or will the escalating trade war continue to weigh on the world's second largest economy? Joining me now is Brendan Ahern, CraneShares CIO. So Brendan, PDD has been one of the strongest China tech names this year. Its results often a barometer when it comes to the Chinese consumer. How significant do you think this company, the earnings results that we saw, is a gauge for the broader market?
Certainly the company is very much geared to the Chinese consumption, which is benefiting from stimulus from the government. They're doing this big trade-in subsidy programs. So we saw that from top-line growth from companies like JD, from PDD today, where they grew top-line growth 7% year over year. At the same time, the competition across e-commerce, Meituan, Alibaba, JD, really fierce. And that's where, yes, they did beat on net income, EPS. Those were actually declines year over year. So the cost of revenue is increasing despite the backdrop of the macro improving slightly.
And it's interesting to me, too, because we constantly talk about the stimulus measures that China has rolled out, right? Like liquidity injections, targeted support for AI and the digital economy. But how durable is this rally if it's so dependent on fiscal policy? Is that enough to sustain this over the long term?
I think because of the effect the trade war, and really it's a goods trade war, so Chinese exports to the U.S. are being adversely affected. That's weighing on an element of the economy. So the government is keeping this kind of pedal on their foot on the gas pedal in order to try to raise domestic consumption, really offset some of the weakness that you're going to see on the export side. So we don't see that going away. I think the bigger issue is just this competition that we're seeing across the major players. We have Meituan reporting on Wednesday, Alibaba on Friday. And do we see the same sort of effect? Yeah, top line growth, but maybe some weakness. So within the K-Web ecosystem, we actually really like online video, online entertainment, online gaming, mobile payments, a little bit more so than what we're seeing due to this real competition in e-commerce.
And what companies within that sector do you think are best positioned?
Tencent, we had really strong results. Bilibili, Kuaishou, Tencent Music Entertainment. These are companies that are a bit away from this e-commerce element where you have this real fierce competition, something that might actually raise the ire where we might actually see some government intervention to try to prevent some of this kind of profitless competition.
Also, China's semiconductors, right? There's reports that Beijing might halt purchases of Nvidia's H20 chips over security concerns. How significant would that be for local chip makers and really for U.S.-China tech relations?
We've seen this over the last really 2 trading days where the onshore, the mainland semiconductor names have just been absolutely flying. Companies like Camercom, Huhong Semi, just 10-20% returns over 2 days. So we see that in our Starboard ETF, K-Star. So I think that's something that's going to benefit. Hopefully we see U.S.-China trade talks improve a little bit. We know a lot of the underlings are talking. Potentially maybe we'll see a Trump-Xi summit over the next several months. Obviously for Nvidia, particularly for U.S. investors, where it's such a key pillar to the success, really holding up the U.S. market, as you mentioned, particularly today. I mean, you can't really see 12, 13% of Nvidia's revenue go to zero.
Are these Chinese chip innovations, are they starting to catch up in a meaningful way? Could you ever see a world where China is not as reliant on the US or those Nvidia chips?
I mean, if the current policies are maintained, you'd assume China has no choice but to develop that onshore capability. I think the example would be what we saw with Huawei, where under the previous administrations, there was an effort to bankrupt Huawei, and the company either was going to innovate or go bankrupt. They innovated, and they are Apple's worst nightmare, because the Huawei ProMate 60 Plus is better than a smartphone. And so the government policy, sometimes with that short-term focus, can create long-term issues, and we don't want to see what Huawei Apple play out into something with an incredibly key company like Nvidia.
Yeah, you are hearing more about the Huawei competition when it comes to Apple. So we'll see if Tim Cook has any tricks up his sleeve here.
For sure.
But Brendan, thank you so much. Appreciate it.
Thank you, Allie.
Coming up, what should investors expect from Nvidia's stock after the chipmaker reports earnings on Wednesday? Jared Blikre takes a look in the latest episode of Stocks in Translation. That's next.
Nvidia is once again approaching record highs after an 8% pullback, and just in time for earnings this week. In today's Stocks in Translation, we're taking a look at what tends to happen to the stock historically after reporting quarterly earnings. First, let's take a look at what would happen if you bought Nvidia just before the last earnings announcement and you held for various parts of time here. So we have 1 day, 1 week, 1 month, 1 quarter, and 1 year. So again, you're buying just before the announcement, and then you're holding for a period of either a day here, and the median return is 3% for a day, 4% for a week, and 3% for a month. It's not great, and by the way, we're using median for some technical reasons here, but it's very similar to an average. And sometimes the announcement is going to send stocks up, and sometimes it's going to send it down, but when you average it out or median it all out, you don't really see outsized returns until you start holding for longer periods of time. And this is because Nvidia stock has tended to go up over long periods of time. So when you get to the 1 quarter period, you see median returns of 17%. But what really stands out here is the 1 year holding time, because then you can actually double your money plus. That's 117% return for a 1 year holding time. And this, by the way, goes back 10 years. Now, it's not just median returns that we're looking for. We also want to see what percentage of the time are we right. And so for the 1 day time period, we're right 63% of the time if we're buying. That means that you actually should have shorted about 37% of the time. Then for 1 week, it's 68%. 1 month, it's 60%. This might seem like it's decent because it's over 50%, but in my own personal work here, I like to see a return percentage positive of more than 70%, and that's because stocks tend to go up. So once again, when you get to the 1 quarter period, you're seeing percent positive returns 77% of the time, and then not surprisingly, we see the best with 1 year. That's 83% of the time you would see those positive returns. Now, we have one more chart here. This goes back all the way to the beginning of the century. And let's think of it this way. If you had bought and held for 1 year after each of these earnings reports, this would be your profit and loss over time. So again, you're only holding 1 year, and we've also smoothed this over 10 periods, which amounts to 2.5 years, 4 reports per year. What you can see is we've actually gone negative a few times, so buying and holding is not always the right strategy for at least for the 1 year time period, but starting in 2015 and going forward, we started seeing some outsized returns. And now you can see over the last 2.5 years, we are up over 150%. And of course, this can go down, but it's a good reminder that for buying a stock, and especially if you're not a market timer, best to hold for longer periods of time. Finally, I'm going to close with some statistics here. The first statistic here is derived from the options market. Now, if you're a trader, you want to know, and especially a short-term trader, you want to know how much the stock is expected to move right after the report into the close of filing day, keeping in mind that the announcement comes after the market close on Wednesday. So into Thursday's close, options market is predicting a move of 5.8%. Now, this doesn't tell you which way the direction it's going to go. Could go up, could go down, but that's the volatility, as we like to say. Now, here's what has actually happened over the last 2.5 years. It has gone up or down about 11.8%. So what you might notice is the options market is expecting less volatility than we've seen over the last 2.5 years. And this is because, and it's informed by this statistic right here, the average daily movement over the last 3 months, not including the last earnings report, but going back to late May, it's only been 2.6%. Volatility has really been reined in on the stock, and so expectations for volatility Wednesday into Thursday close, those have also come down. So putting it all together, Nvidia holders, you probably want to hold for that 1 year time or greater. And tune in to the next Stocks and Translation podcast for more jargon-busting deep dives. New episodes could be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts after this.
Several key pieces of economic data are on tap this week, culminating in the Fed's preferred inflation gauge, the PCE index, on Friday. At Jackson Hole, Chair Powell reaffirmed the Fed's aim of bringing inflation back down to 2%. But former Treasury Secretary Larry Summers told Yahoo Finance earlier today that he's not convinced that goal is achievable. Let's take a listen.
I think the biggest medium-term risk is that we are never going to achieve a successful, sustained return to 2% inflation. And I think if that happens, there will be a general erosion of the Fed's credibility.
Joining me now is Citi economist Veronica Clark. So Veronica, you just heard Larry Summers there. He warns the Fed may never achieve a sustained return to 2% inflation and that credibility could be at risk. What's your reaction to that? And will Friday's PCE data help clarify whether inflation is actually on a path back to target?
Yeah, I think it's fair to have that concern, and there are reasons over the longer term that you might see more persistence to inflation than we saw pre-pandemic. But I'd say in the more medium term, the next year or so, some underlying slowing in demand. It does look like in components like shelter inflation, like we could see some more slowing for sure.
Now, on Powell's Jackson Hole speech, he now seems to be framing tariff-driven inflation as more of a one-time price increase. But earlier this year, the Fed wasn't sure if tariff effects would be transitory. So why that shift in tone, and how did you interpret it?
Yeah, I think that was probably some of the more dovish elements of his speech on Friday, saying that it is this one-time, price level shift higher. But one time does not necessarily mean all at once, too. They're kind of setting up to look through some multiple stronger inflation readings. But I think that's a fair assessment, given a slower demand backdrop.
We also don't have a Fed that's fully aligned on cuts or the possibility of cuts. The latest Fed minutes showed plenty of concern about inflation. So how divided do you think the committee will be heading into September?
Yeah, certainly they still are. We have not heard from all Fed officials that everyone is on board with cuts. Obviously, we have a lot more data to go through. August jobs report next Friday, another August CPI reading. So maybe the data will give a bit more clarity, but I don't think they're all on board yet.
Now, Powell also flagged risks to employment. And the unemployment rate, it's still low, but job creation is basically flatlined at this point. Immigration is slowing. Does that make the unemployment rate a less reliable gauge of economic strength right now?
Yeah, I think that is still probably the single most important labor market statistic for the Fed. It is still probably the best measure of how demand and supply are evolving together. But Chair Powell was pretty clear that if you do see a stable unemployment rate, relative to the last year or so, but we know that labor supply has come down a lot. That tells you that labor demand has also come down even more. So I think that is still probably the single best measure. But the fact that demand is slowing, it does mean that there are those downside risks out there still.
And given all of that together, right, the inflation concerns, the potential slowing of the labor market to a point that it hits growth, that scary word stagflation seems to be popping up more and more often. Have those odds increased in your view?
Yeah, it is tricky because we could have a period where the data certainly look like a stagflationary episode where growth is softer, maybe labor market is weakening, but we're still getting this strong inflation data. But I think the fundamentals, is this really true persistent inflation? I think that comes down to the demand side of things. And if you do see housing weakening, labor market softening, you're not seeing wage growth, that is not a sign of persistent inflation. So yeah, you might see the data that look pretty uncomfortable for a period, but you're not necessarily worried about the real persistent inflation risk then.
What would you need to see that would make you a little bit more uncomfortable? Are there certain indicators that investors can look at that maybe signal stagflation is on our doorstep or at least coming around the corner?
Yeah, I think, to see signs of a real concerning kind of persistence to inflation, I would, of course, look at inflation expectations. That's what the Fed will look at too, but also other inflation adjacent data. I would put wages in that category, home prices, new rent growth. All of that has been very soft. So yeah, even if you see the level set higher in certain goods prices, the underlying fundamentals suggest that prices more broadly would be weakening.
And finally, Fed independence has obviously been a big topic so far this year. If President Trump were to fire Lisa Cook, he nominated Stephen Murrin. Are you concerned about the level of his political involvement in the Fed at this point?
Yeah, I mean, it's obviously a huge topic, and it really will just depend on who is in place. Obviously, a lot of focus on whoever the next Fed chair will be. If it is someone like Governor Waller, I think the market is more familiar, more comfortable with him. And I am not expecting that the Fed is making politically based decisions. They are still making decisions by majority vote. And I think the data will have to be there to understand that decision.
And if there were concerns about Fed independence, do you think we would see that immediate reaction in the bond market?
Yeah, we certainly could. It was a couple weeks ago or maybe a month ago at this point where we got those headlines about potential to fire Powell. And we saw the pretty quick market reaction. Long end yields went higher, which is a little bit what the administration does not want to see, right? If longer end yields, that's where mortgage rates are going to be tied to. That's kind of the opposite intention of what you're trying to do. So yeah, I think we would maybe see a market reaction pretty quickly if there's a real issue there.
Yeah, the so-called bond vigilantes. But at this point, we are seeing stable yields across the board here. Veronica, thanks so much.
Thank you.
All your market action is straight ahead. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and we're seeing a bit of a mixed picture here when it comes to all three major indices. Taking a closer look at the YF Interactive, we have the Dow down about 0.5%. The S&P 500 also in the red this morning, down about 0.1%. And the NASDAQ reversing the slip in early trading session, now seeing some momentum there, up nearly 0.3%. And taking a deep dive under the hood, what exactly is driving that reverse to the upside is Nvidia. Nvidia seeing some momentum ahead of its key earnings report this week. That stock up nearly 2% in intraday trading, and over the past 5 days, it's roughly flat. But really, we've seen this momentum. And Citi's Stuart Kaiser saying in a note over the weekend that Nvidia earnings are the next quote-unquote macro event on the calendar. He even calls it the largest event risk on the calendar until the September FOMC meeting. And that really emphasizes the key indication that this company has when it comes to the AI revolution and this rally that we've seen in the stock market as of late. You could see all big tech really in the green, offsetting the declines that we're seeing among companies in the red this morning, including Keurig Dr. Pepper, which announced that it was buying JD Peets for $18 billion. That stock down nearly 2.5%. I also want to take a look at retail. It's a big week for retail stocks as Gap, Abercrombie & Fitch, among others, are set to report. Those stocks seeing some momentum when it comes to Amazon, Nike, and Abercrombie & Fitch, Kohl's ahead of their report. But I also want to point out Wayfair, because that stock is seeing major pressure continuing this morning after it fell on, or rather it was in the green and then it fell after that announcement that President Trump said that the U.S. is investigating furniture imports and will oppose a tariff on the products once the probe is complete, emphasizing that he wants to bring back furniture manufacturing to the U.S., North Carolina, South Carolina, and Michigan. That stock has been largely under pressure year to date, or rather up year to date more than 60%, as it was able to sort of navigate the tariff environment. Once again, taking a step back, all three major indices, a bit of a mixed picture here, but the Nasdaq holding on to that momentum. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching American Eagle, Puma, and Apple. First up, American Eagle falling as Bank of America cut the retailer to underperform from neutral amid tariff pressures on profitability. Still with us is our own Brooke DePalma. And Brooke, we've been hearing this earnings season that businesses, they're absorbing a lot of these tariff-related costs, but at some point, it's only a matter of time before that cost gets passed on to the consumer.
Yeah, absolutely. And that's one of the points that led Bank of America to downgrade American Eagle from neutral to underperform this morning. They cited navigating tariffs is one of the ways that will hit earnings recovery. They also said that it's a tough environment for a company to turn around as consumer demand and pricing, as well as their ability to offset tariffs, all come into play here. And also, interestingly enough, the company also saying that Sydney Sweeney ad that got so much attention as of late, well, that could present a near-term catalyst to sales growth, but then long-term, that could then impact sales there. So it's worth noting that this company is down more than 24% year to date, but over the past month after that Sydney Sweeney ad, we did see some momentum to the upside, up nearly 8%. And so there's lots of puts and takes when it comes to this company and how exactly they plan to turn around in this environment, lean into promotions. If they pull back from that, that could impact traffic. And so there's lots of different factors going into this, and that's what largely led to the downgrade that we're seeing this morning.
Yeah, a lot of controversy over that ad. But next up, Puma, shares surging in European trading today. Bloomberg News reporting the billionaire Pinot family is weighing options for the German sportswear company, including a sale. And Brooke, clearly investors are liking this. You're seeing a 15% pop today.
Yeah, 15% pop, and it was up as much as 20%, and that was actually the largest jump since early October of 2001. So pretty impressive move coming around Puma this morning. It's worth noting that there's no official and no definite confirmation of this to be announced sale, but this stock has been under pressure, down more than 40% from a year ago, as largely there's been this fear around the impact of tariffs on the company, as we noted, similar to American Eagle, and also their profit outlook because of that. And also, this is a company that has been under pressure because of the lack of demand that has been around their gear, as well as just sports apparel in general. You know, it's interesting to see the way Puma take this with stride. It's definitely an interesting market around luxury right now as the demand sort of weakens in the near term.
And finally, let's get a check on Apple. The iPhone maker, along with OpenAI, have been sued by Elon Musk. Elon Musk accused the companies in a lawsuit of unfairly favoring the ChatGPT app across iPhones and thwarting competition for other chatbot makers. Now, Brooke, we're not seeing Apple shares react too much off of these headlines, but it does call into question how regulators, how the courts might view Apple's role in the AI ecosystem moving forward.
Yeah, Allie, first instinct was also to check Apple stock, and it actually saw some slip to the downside, up about 0.3%, and now it's seeing a bit of a reversal, up nearly 0.6%. And this is a company that over the past month has gained momentum, up more than 12%. And year to date, the company has been under pressure, down more than 8.5%. But this is two of Elon Musk's companies, X and XAI, and once again, they're suing Apple and OpenAI over what the filing says an anti-competitive scheme. I was reading a bit into the filing, and they said that as Apple now recognizes that AI poses an existential threat to the business, they looked to get ahead, rapidly trying to, quote unquote, advance the rise of super apps. They also went on to say that in June 2024, Apple and OpenAI announced that Apple would integrate OpenAI's ChatGPT into the Apple iPhone operating system, and that impacted the potential of iPhone users using other, quote unquote, more innovative and imaginative products like xAI's Gronk. That's one of the companies that are in this lawsuit. They also went on to say that working in tandems, Apple and AI have locked up markets to maintain their monopolies and prevent innovators like X and xAI launch. AI from competing. We know that a new iPhone is set to be launched. That's according to a note from Bank of America. Their launch event is Tuesday, September 9th. There's a potential, speculation around this new iPhone that integrates AI. And really what investors have been looking for in this market is how exactly Apple will get into this AI game, how exactly they're going to play in this AI arms revolution. And so this is really just another hiccup that Apple is facing as they look to get ahead. In that note, they also said that at this event, they're really going to be focusing in on how exactly Apple plans to better integrate both AI and Siri. And so there's been so much discussion about Apple's role in the AI revolution that we're seeing right now. And certainly this comes into a bit of question, but investors not too fearful of it.
All right, Brooke, thank you so much for breaking that down with us. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, all your market action is straight ahead. Stay tuned. You're watching Market Catalysts. Several European freight companies announced plans this weekend to pause shipments to the U.S., citing uncertainty over the de minimis tariff exemption ending. Goods valued under $800 were permitted to enter the U.S. duty-free under the so-called de minimis exemption. That rule will end on August 29th, significantly raising costs for imported goods. Joining me now with more on what this means for retailers and U.S. consumers, Sonia Lipinski, partner, managing director, and leader of fashion retail at Alex Partners. Sonia, thanks for being here. I mean, this is super interesting. We had different European companies, DHL, Royal Mail, already halting some of these shipments to the U.S. What industries and categories are most exposed to this disruption right now?
So this has been a huge kind of end of a loophole for the retail industry when we think about categories like apparel and footwear in particular, and any kind of small goods that might be shipping direct to consumers. Originally, when the loophole was created, it was to kind of spur e-commerce revenue and just get some demand going. And it really led to a lot of the big fast fashion retailers hugely taking market share. So if you think of the Sheins and Temus, they started to be able to ship product directly to the consumer. They paid no duty on those products because it was under the $800 maximum or minimum. And it was cheap, super cheap goods that everybody benefited from for years. So retailers knew this was going to go away. They thought it was going to be another year or two, and all of a sudden it's a quick end to any of that advantage.
What does this mean for U.S. shoppers? Because this has been in place since the 30s, I believe.
It's actually, I think it was really kick-started around 14, 15. When they put in place they increased the minimum from 200 to 800. So that was when things really got going for these retailers shipping direct. So for consumers, I mean, consumers who are used to buying really cheap apparel and other goods, they're going to see a significant increase in the cost of that. For retailers in the U.S., however, it actually can be seen as a bit of an advantage. A lot of them who are selling similar goods, they're importing in bulk, so they're paying the duty on everything coming into the U.S. and then shipping from distribution centers. If a competitor is shipping direct with no duty, then the retailer in the U.S. is at a disadvantage. Now it's going to level the playing field a little bit. Even Forever 21 mentioned when they went bankrupt back in March that this was the de minimis was a significant contribution to why they were losing market share because they were competing directly with Shein. So for those that are in that same kind of competitive pool, they actually have more of the benefit is equalized.
You mentioned Shein, and Chinese retailers like Temu, Shein, they lost their de minimis relief back in May. So this is not China, this is Europe. But what's the fallout been there, and what lessons could U.S. and European retailers take from that experience?
Yeah, well, I think we're going to have to see, pricing is generally, we think, is going to go up across the board. Consumers have already started to see some of those price increases in stores, even this summer, but we really expect them to hit in the fall.
And does that show up in what you're paying for the actual good, or is that a tax? How does that look like?
No, it's actually the cost of goods for consumers is rising, but even before any of the talk of tariffs, we saw for apparel and footwear categories, kind of the beginning of this this year, prices were still up year over year prior to the tariffs coming in place. Then we layer on the tariffs, now we get rid of de minimis. So even US retailers, some of them are benefiting from de minimis. That's going away. So there's all of these pressure on retailers. Some of the price increases were passed on this summer, but there was a highly promotional environment. So there were some increases, but it was offset by much of the store was going to be discounted and super promotions. So now the consumer is going to go into the fall. The promotions are largely going to be gone, potentially, and we're going to have the full impact of any of these increases passed on.
Okay, so a lot of a more heavy burden for the consumer. And when you're advising some of these retail companies, what do you tell them to do in order to prepare?
Retailers are doing so many things, and they have been for the last 3 or 4 months. So they're definitely looking at where they're sourcing product from. So we saw a lot of that happening in the spring when we were first reacting to the tariffs and Liberation Day. I think Steve Madden was one who announced that they were going to be entirely out of China, and I think they're down to single or double digits left. This is just since last fall. So significant shifts of where they're buying goods. That's one strategy. They're negotiating really hard with their suppliers, so trying to share in some of this pain because the suppliers are going to feel it as well. They're raising prices in some pieces. They don't want to talk about it a lot because they don't want to scare consumers, but strategically they're raising prices. And then they're looking across their enterprises. We're telling them, you really got to get your costs in line across the board. So they're looking everywhere to make sure everything's in line. They're running efficiently. Their operations are under control to offset some of the margin impact.
Yeah, lots of changes in the retail space. Sonia, thank you so much. Appreciate it. Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance straight ahead.